welcome back to the Investor Coaching TV show. We were talking about fees versus commissions, and I'm going to talk about something that's very related. Fees, commissions. One of the most commonly sold products to investors are variable annuities. Variable annuities, you have an annuity as an insurance company product. It has certain tax advantages. When I put money into an annuity, non-qualified money, let's say I take money out of my mattress or out of a savings account and I stick it into the annuity, it grows without taxation. Now, a lot of times investment advisors will recommend variable annuities because you have mutual funds that you can actually invest in inside and get tax-deferred growth. They do have purposes. There are some reasons to use these things, but most commonly, the wrong type of variable annuities are recommended. I recommend no-load variable annuities where there are no commissions and you can reduce the expenses. But actually what I'm going to talk about right now is an article written by a securities attorney, Dan Solon, wrote this article called Variable Annuities, Greed at Work. And it was in U.S. News. It was a blog that he had done for U.S. News. And I want to point out a couple paragraphs in this blog. Variable annuities, one of the things he said is, I have a friend who recently immigrated to this country. He is a hardworking professional with no sophistication in investments. He had accumulated a meaningful amount of money in his 401k plan and had additional savings he wanted to invest. He consulted with a number of brokers. All of them made the same recommendation. Imagine that. He should purchase a variable annuity. This recommendation made no sense to me from an investment perspective. It made perfect sense when you consider the economic self-interest of the broker. According to Smart Money, magazine written by the Wall Street Journal, commissions on the sale of variable annuities are 5% or more. My friend had about $200,000 to invest. You can do the math. And this is written, like I said, from a perspective of a securities attorney. You know, you have these people, let's say if you have a dispute with a broker or a broker-dealer or an investment firm, you would hire a securities attorney to fight your case for you. That's what this guy does for a living. Now, the next paragraph, he said this. He said, a variable annuity is a complex investment with often excessive commissions. They have an insurance component touted to protect you from capital losses. More about that in just a second. The investment options are often limited to predominantly high expense ratio, that's the management fee, actively managed funds. In other words, they do stock picking and market timing is what he's talking about right there. Actively managed meaning they're going to try to figure out which stocks are better than others. And I've done many shows talking about how that's a huge waste of time and a waste of money on your behalf, because what they're doing is looking for mispricings in the stock market. And everybody's doing that. Everybody would love to find stocks that are selling for 50 bucks that, they're really worth 70, and we can make you a whole lot of money by buying them for 50, and when they go to 70, we'll sell them, we'll make you all kinds of money. Problem is, nobody has shown the ability long term to actually be able to do that. Matter of fact, New York Times had that article I've talked about on this show before, the prescient are few. Literally, they found that over 99% of mutual fund managers failed to beat the market. So literally what Dan Solon is talking about here is, yeah, they're actively managing, and that's just a waste of time. You are penalized, he says, for withdrawals before you reach age 59 and a half. So if you pull that money out, it's grown, and you pull the money out, you've got a penalty for early withdrawals plus taxation on any gains. Additional penalties may accrue if you surrender your policy before a stated period of time, often 5 years or more after purchase. That's the back-end surrender penalty that I was talking about in the previous segment. After you reach age 59 and a half, distributions are taxed as ordinary income at your marginal tax rate at the time, regardless of how long you held the investment. Now, the issue with variable annuities, let me just point out, is if I put $100,000 in and it grows to $150,000, non-qualified investment, just basically after-tax money, what happens is I've got to burn through the $50,000 of gain before I get my $100,000 back. So it's all taxable. It's last in, first out. Not a really good tax consequence for an investor. So a lot of times you really got to watch out using annuities for the tax implications that they actually provide and some of the problems that you can actually run into with them. Now, he says this. He says the protection, quote unquote, protection of capital feature. That's what he was talking about earlier. You can put the money in, you have protection against market downturns. The feature in variable annuities is largely illusory. And, he says basically it's an illusion. It's the grand illusion. Sticks would be proud, right? Much is made of the fact that your beneficiaries will receive at least the amount of your net investment in the annuity if you die before beginning withdrawals. And he says the likelihood of moderately diversified portfolio being worth less after any meaningful period of time than the amount of money originally invested is very small, making this quote-unquote benefit of little value. Absolutely true. If you think about it, investment markets go up and go down, but if you properly diversify and you have a moderately mixed portfolio, the likelihood of going a really long period of time with no return is pretty low. Last decade, they call it the lost decade. And the reason it was lost decade was because most investors weren't diversified. If you were diversified in the last decade, all stock portfolio doubled in value. So he's got a really good point right here regarding that. Former SEC economist Greg McCain reviewed variable annuities in a white paper. He concluded that most are likely to be unsuitable in virtually every instance. That's a pretty strong statement, because investors would probably be better off investing in mutual funds or a portfolio of stocks. He correctly attributes the sale of over $1 trillion in assets held by variable annuities to, quote, powerful incentives created by the insurance industry with generous commissions and a massive fraud they engender. Really powerful statement there. Common recommendation of variable annuities to investors is yet another example of rampant greed on Wall Street. It represents a clear conflict of interest. This is a witch's brew for investors. And really he makes a good point right here that there is all kinds of conflict of interest in the investing community, and really variable annuities are just the start of it. Variable annuities, however, can make sense in some instances, but if you're going to buy them, I would recommend a no-load variable annuity where there is no commission to the advisor. It takes away that conflict of interest and, of course, reduces the expenses tremendously. The insurance company expenses come down. Anybody that is trying to entice you based on that guarantee that he was talking about, I don't recommend it, because the guarantee, like he said, is not as valuable, and insurance companies have actually been running from some of the guarantees lately. That's it for today's show. Hope you enjoyed the Investor Coaching Show. I'll catch you next time.